Hello and welcome back. Happy Sunday morning to everybody. Thank you for joining. Just let's wait another few seconds to allow everybody to join in. All right, welcome again. My name is Chris Manfre, for those of you who don't know me, and I'm one of the lead instructors at the American Institute of Finance. And today we're going to talk about pricing stocks, and this is actually the second part. So please go check the first part if you missed it, and so you can get a better understanding of where we're coming from. So last week we looked at the last week we looked at the valuation of stocks, and we looked at different models. So we looked at the dividend model, we looked at the free cash flow model, and we looked at the earnings model. And this is basically the formula for the free cash flow model. We said free cash flow is actually a good way to go, because free cash flow represents the amount of resources available to the company to pay out dividends, whether they decide to pay dividends or not. And so we applied the formula. Actually, for those of you who attended, you might remember we applied this formula specifically to Starbucks, and we were able to come up with the particular price per share for the company. But one thing that we did not do, as you might recall, is that we did not calculate the R. Let me see if I can actually point this out. So this R here was not computed, and we used something that was about 6%. And I said, I have faith for now. We're not going to be able to calculate it today, but we'll do it next time. So this is what we're going to do today. Basically, we're going to look at the R here and see how that can be computed. So we complete the picture, and we have the ability to basically estimate the price of the stock. Okay. Now, if we look at we had a similar slide actually last week. Let me see if I can go to that slide. There you go. So what you see here is similarly to what we did last week. We have a stylized balance sheet with the left side, which represents the business enterprise value, and the right side that represents the way we finance those assets. So debt and equity, right? And there are different types of flavors there, of course, different types of debt and equity. But what I want to emphasize that, again, we're dealing with the equity side. So we're going to look at the cost of equity that pertains to the equity component, right? And it's important to say that because, so this part here, because we could actually look at the cost of capital that pertains to the entire organization, to the entire company, and that would be related to the left side of this stylized balance sheet, and that's what we call the weighted average cost of capital. But today we're just going to look at the price in stocks, right? So that's our objective, and so we're going to look just at the cost of equity. Okay, so let's erase drawing. All right, so how do we compute the cost of capital, and specifically in this case, the cost of equity? Well, there are a few different ways of doing it. Obviously, one way is to look at the historical return, right? That a particular stock offered to its investors over time. And you can go back to our very first session. We actually calculated the daily return, that we transformed it into a annual return. So please go back and check that if you're interested in that. So that's one way to go. And sometimes we refer to that as historical return, of course, also expected return. If the stock is going to, in a way, behave similarly to what it did in the past, then we can expect that the same type of return. Sorry for the echo. Okay, so we have three methodologies. We have the capital asset pricing model, CAPM, and we have the Fama-French three-factor model, and we have the APT model. There could be other models, but these are the most well-known models that we use to calculate the cost of capital. Now, the most well-renowned and utilized is actually the first one, the capital asset pricing model. This is if you do not want to just rely on historical data and you want to calculate a return that can be actually inferred based on what the market will do going forward. So it's something that we don't know yet, right? That's the power of the capital asset pricing model. We can have a model that based on how the market overall is going to behave, is going to give us some direction in terms of how the specific stock should behave itself. Okay, so that's our focus. We're going to look at the capital asset pricing models in the next few slides that I put together for today. Okay, so this is the model. The model itself is relatively straightforward. So let me go through each and every single element here, and then we can obviously try to calculate that together. So R, which is the component, the cost of capital that we were trying to identify for us in order to be able to calculate the alleged price per share of a particular stock. Then we have RF, you can see also down here. RF is the risk-free rate, so the minimum return that we should expect to obtain. Okay. And what kind of return are we basically talking about in terms of the risk-free rate? Well, we typically rely on the 20-year treasury, the yield on the 20-year treasury bond. Okay, so this is the bare minimum that we should expect to receive, right, for investing in any type of security. It makes sense, right, because we should at least get the risk-free rate, which again can be identified with the yield on the 20-year treasury bond. Then continuing on, we have the beta, and we'll talk quite a bit about beta because that's really the ingredient that we need to identify in order to be able to put together the capital asset pricing model. So the beta represents the market risk for an individual security. The market risk for an individual security. We talked about a different type of risk measure before. If you looked at our session 1, session 2, we talked about standard deviation. But today we introduced these different type of risk measure, which is, again, beta, which is a type of risk measure that allows us to see how risky we are as compared to the market overall. And then, as you can see, the last element here is ERP, which is the equity risk premium. The equity risk premium represents the additional return that you should receive for investing in the stock market. Again, why do you invest in the stock market? There must be a reward. There must be something that you would not receive otherwise, and that is the ERP. I can anticipate that the ERP typically is between 5% and 7%. So for our purposes today, we can assume that the ERP is actually 6%. Now, as I promised, we wanted to do this, for example, for Starbucks. So let's say we want to put together, again, the R for Starbucks. So what we can do, we can first of all look at the risk-free rate. And for doing that, we can actually go to the website of the Federal Reserve. Let me see if I can get you there. Okay, so if we go here and we scroll, this is actually H15 so-called. So if you go to the federalreserve.gov/releases/H15, as you can see in the web address of this page, what you can see scrolling down, let's see if we can scroll down. Now you're going to see different dates, and you're going to see a different maturity on the left side of the screen. So what we should pick, as I mentioned, is the 20-year Treasury bond, the yield on the 20-year Treasury bond. So if we keep scrolling down, there you go. Now we get the 20-year Treasury bond, and we see that that is actually 1.09%. That is a percentage. Okay, so we have the first ingredient for the calculation of our return, what we call actually the required return. Okay, so let's take a note, 1.09, and now let's go to Yahoo Finance. And I already looked for Starbucks in this particular case, and you can see that we have our beta of 0.79. So we can take a note, and we can write. You can see that it's beta 5-year monthly, and I'm going to talk a little more about beta because we'll see that we can actually calculate our own beta. But for the first step here, we're going to rely on the beta that is provided by Yahoo Finance, so we don't have to compute it ourselves. Okay, so now 1.09% was the risk-free rate, and 0.79, which is not a percentage, it's just a number, is the beta for Starbucks. So we can go back to our slide. There you go. So let's try to actually do this calculation. So we have, let's see if I can write on this. So it's not allowing me to write. Let's see, 1.09. Okay, yeah, that works. Plus 0.79 multiplied by 6%. Hey, by the way, also this is a percentage. Okay, so I'm actually using my phone. Let me try to do this. So first I start with 0.79 multiplied by 6%. Okay, so 4.74%. Actually 4.74%. Okay, and then we have 1.09% here. Let's see. It's not letting me write. Okay. So let's see what that could be. Okay, 1.09% plus 4.74%. That's actually 5. I want to go back and put it in red if I can. Let me see if I can write it here somewhere. 5. It doesn't let me write it for whatever reason. Anyway, okay. Let's try here. 5.83%. There you go. So if we do this calculation, this is what we get, right? Okay, so this is our expected return, or a required return, should I say, for Starbucks. And if you attended last session, you might remember I actually used 6.25%, something along those lines. So we actually see that with interest rates being low as we speak, this required return is actually even lower than what we used last week for the purpose of pricing the stock, and specifically for Starbucks. Okay, great. So let me erase the drawing here. Okay, let's go to the next slide. Okay, so let's talk a little bit about beta, since I just used it in our CAPM calculation. Um, as I mentioned, this is a risk measure of a specific security is related to the overall market. One thing that we need to know about beta is that beta is a type of risk for a well-diversified actually investor, right? So the type of return that we're looking at should be the return that you should expect as an investor if you have actually a diversified portfolio. If you're investing just specifically in one stock, Starbucks, for example, perhaps it would not be a perfect measure for the required return. I can also, I'm showing you also on the slide that the beta can be calculated mathematically in the way you see in the last bullet point. So basically, that would be rho, which is the coefficient of correlation, multiplied by the standard deviation of the stock, divided by the standard deviation of the overall market. But you probably lost me there when I started talking about rho and standard deviation. So there is actually a more practical way of doing this, which I'm going to show you in a moment. Okay, so we can actually calculate our own beta, as I promised you a few minutes ago. So how is beta interpreted before we get to that point? Well, beta of 1 means that the stock has an average risk, and it has the same risk as the market overall. So as you understand, if you multiply 1 by the equity risk premium of 6%, which is what we used, that means that the stock is neither more risky than the market nor less risky than the market. And if beta is bigger than 1, the stock is riskier actually than average. So that means that if the market goes up by 1% and beta happens to be, for example, 2%, it means that the stock would move actually by 2%. So you can see that a beta that is bigger than the market amplifies the movement of the specific stock, right? And so that makes it, by using the language of CAPM, it makes it riskier, right, than the market overall. Conversely, if you, in the next bullet point, if you see beta less than 1, that means that the stock is actually less risky than the market. So again, if the market is going up by 1% and the beta of the stock happens to be 0.5, that means that the specific stock would just move by 0.5%. Okay, so that's the way we interpret beta, and it's very useful because we know that once we have the beta, we can anticipate the way the stock will behave. So for example, we looked at Starbucks, we noticed that Starbucks beta was 0.79. That means that Starbucks overall is less risky than the market, and so when the stock market goes down by 1%, Starbucks on average, and obviously this is on average, it doesn't refer to a specific day, it means that it would drop by just 0.79%. So that's again a way to look at beta, to interpret beta. Now, as you can see, the last 2 bullet points, I say, can a stock have a negative beta? And the answer is yes, it can, right? So that means that actually a specific security, a specific stock would move in the opposite direction of the market. So if the market goes up, the specific stock would actually go down, right? It's not easy to identify stocks with a negative beta, but they do exist in the marketplace. And then the very last question, I say, can a security have a 0 beta? And I say, yes, it can, right? Because it can be positive, it can be negative, and certainly it can be equal to 0. Although it's unlikely that you're going to find a stock that has exactly a beta equal to 0. It is definitely a possibility. Okay, so how do we calculate beta? Right, that's what I want to discuss with the remaining during the remaining portion of our time today. And so again, beta measures the stock volatility relative to the market. How is it done in practically? Well, we typically have to define the market, right? So I've been making references to the market. And so certainly a very common way of doing this is using the S&P 500 index, right? And very often that is what we mean by the market. But depending on where you are in the world, right, you might be able to use different indices, and you still can use CAPM as a way to identify or measure the required return of a particular stock. Another index that I've used in the past is actually the MSCI, which is a global index, right? So if you're looking at a company that is a multinational corporation, for example, that plays on a global level, you might be able to calculate, you might want to calculate a CAPM that we call a global CAPM, right? In that case, you would actually look at the MSCI index rather than the national US S&P 500 index. Okay. Now, what type of returns are we looking at? For how long? As I mentioned, when I looked at the Yahoo Finance for Starbucks, actually it said 5 years monthly, and that's exactly what we typically use. It's 5 years monthly returns for the specific stock and the market that we pick. Let's say the S&P 500, right? Some analysts like to use weekly data, but very often what we use is actually monthly data if possible. We might use weekly data if, for example, the stock hasn't been trading for 5 years. For example, if you try to calculate the beta for Zoom hasn't been public for that long, so you might not have access to 5 year worth of data. So what you can do instead, you can rely on weekly data, and that's a way to get around the 5 year or 60-month limit. Okay, I see a question. How does Starbucks beta compare to Dunkin' Brands beta? Well, I would have to go and look at it. But very likely these types of companies that play in the fast food industry tend to have a beta that is less than 1. And so I actually challenge you to check, go to Yahoo Finance, look at it, and very likely you'll see that also Dunkin' Brands, although I haven't checked it today, you will see that it's less than 1. The same is true for other stocks that are in the fast food industry. So good question. Okay, so using the regression line to estimate beta. Let me jump here. Well, one thing I want to say is that you can use regression analysis, of course, very simple regression analysis that can be done in Excel to calculate the beta. And very often we get confused about what is X and what is Y. And so you have to remember that basically we're looking at what happens to our stock when the market actually moves. So that means that the market plays a role of X and the specific stock plays the role of Y, okay, in this simple regression analysis. Okay, so here I have an example of a stock that doesn't really exist, but I just put some returns there to show you how this can be done. So using historical data for the returns for this stock, which I called PQU, and then we have the return on the market overall. Okay, so basically we would use this two arrays of data in order to estimate our beta. So if we do that, right, for example, we would obtain this type of result. And so what you can see here is the, let me see if I can scribble on it. Okay, so what you can see here, this would be the beta, right, 0.8308, which is the result of the regression analysis done between the PQU stock and the market overall. Okay, so there you go. So this is the type of result that you obtain when you do regression analysis to estimate your beta. Okay, and there you go. So beta equals 0.83. You don't have to actually do the full-fledged or the full-blown regression analysis in Excel or using any other statistical package. You can just, in Excel, you can just use the formula slope, right? You can see it's very easy to do, equal slope, and then you can calculate and capture the ranges of the both the specific stock and the market overall, and you calculate very, very quickly your beta, okay? So what happens is if we calculate the historical return, now in this example here, I'm saying for PQU, let's say we went to calculate the historical return for the stock and we come up with an annualized return of 17.4%. Again, during the first session, we showed how to calculate the historical return. So let's say you get 17.4%. But then you actually calculate the required return by using CAPM, and you come out with 19.1%. How is that possible, right? And that happens all the time. It's very unlikely that you're going to calculate the historical return or the expected return and the required return by using CAPM, and you come out with the same number. So in this case, we are saying that the stock, in a sense, is overvalued. We are saying that the investors paid too much for the stock, right? And so the return actually dropped, right? So there is a lot of appetite, in other words, for this particular stock. I see there is a question. Can you define regression analysis? Okay, so regression analysis, we're simply trying to see, and maybe we'll do it in the next session because we don't have enough time today, but basically what we do, we're trying to understand what happens to one variable when another variable actually moves. So again, in this particular case, we're putting the market and a specific stock together, and we're trying to see what happens to one to the specific stock when the market actually moves, right? So regression analysis tries to capture this relationship, if it exists, by the way, because sometimes we might get a result that doesn't mean anything, right? It's trying to capture the relationship between these two variables, and again, X and Y, right? In its easiest form, we have one independent variable, which means doesn't depend on anything, at least in the model, and we have one dependent variable that depends on the other variable. So we're not going to have time today, unfortunately, but we'll make sure that we're going to tackle that in the next video. Okay, so you'll see how we can do this very quickly in Excel. Okay, so that's actually it for today. We looked at the required return. Let me go back to my first slide. And again, the objective of today's study group session was to try to understand how we calculate R, which is the variable that we used for the purpose of computing or putting together the expected, the price of the stock, right? The price of the stock. So again, this R can be used in the free cash flow model. It can be used in the dividend model. It can be used also with earnings, right? But we do need this R in order to price a specific stock. And so we can use, again, the expected return, which is derived from historical data, or we can use the required return, so-called, by using a different model. And in this particular case, we relied on capital asset pricing model, CAPM. And I walked you through that, how we use it, and how we can actually calculate beta. All right, thank you everybody for attending. Have a great rest of the day, and I look forward to seeing you next week.